Three stocks we are watching right now that we believe the market is seriously underpricing. If your goal is to outperform the S&P 500 over the next few years, these are exactly the kind of businesses that you should be paying attention to. And by the end of this video, you will know which three companies have made our list, why we're considering buying them, and what might drive their next major move. But before we jump in, if you missed our last video on the 5 reasons that all tech stocks might crash, be sure to check that one out because a lot of these themes are really interconnected. The S&P 500 will probably do what it always does. Maybe 6%, maybe even 8% a year, and honestly, that's fine. But if you're trying to generate real outperformance, you need to find businesses that can compound faster than the market. Not hype, not memes, not lottery tickets. Real businesses with real moats. Today, we're looking at 3 businesses that fit that description. 3 completely different markets, 3 completely different business models, but all 3 have something in common. The market is still valuing these companies based on what they were and not what they are going to become. Stanley Druckenmiller remains very bullish on one of these companies. Morgan Stanley just increased its position by 140% in another one. And the third company may be one of the most overlooked value opportunities in all of large cap tech today. Behind each of these 3 companies, we'll break down the opportunities, the risks, and the upside. Let's start with the first one. The first stock we're watching is Sea Limited, ticker SE. And in our opinion, this is one of the most misunderstood businesses in the market today. Most investors look at Sea Limited and see an e-commerce company. That's not what it is. Sea Limited has 3 major growth engines compounding all at the same time. The first is Shopee, its e-commerce platform. Shopee operates across some of the fastest growing consumer markets in the world, particularly Indonesia and Brazil. These are regions with huge populations, rising internet adoption, and years of growth still ahead. The second division is Garena, its gaming business. Historically, Garena helped fund the growth of the rest of the ecosystem and has recently returned to even stronger growth. And the third division is Sea Money. This is the fintech business, digital payments, lending, financial services, and potentially one of the most important parts of the company long term. Now, the reason we like Sea Limited so much is because all 3 of these businesses work together. Shopee attracts users, Sea Money monetizes these users, and Garena continues to support the entire ecosystem. Every additional product increases switching costs. Every additional service strengthens the moat. That's the flywheel. And we've seen this movie before. Amazon built a very similar ecosystem in developed markets. That is exactly what Sea Limited is doing across the emerging markets. At TLI, our fundamental research supports an average price target of around $156 per share. However, our discounted cash flow model suggests upside closer to even $200 per share. Now, from a technical perspective, the stock is currently sitting at a very attractive buy zone. It's retesting major long-term levels and is building a lot of momentum. Even Stanley Druckenmiller appears to agree with the long-term opportunity here. So what's the bottom line? Sea Limited isn't just one business. It's gaming, it's e-commerce, and it's fintech, all rolled into one ecosystem compounding across Southeast Asia. And we still think that the market underestimates what that ecosystem could become. The second company on our watch list is Salesforce, ticker CRM. And this one might be a surprise to some people because Salesforce isn't very exciting. It isn't flashy, and right now it isn't getting much attention. But that is exactly why we're interested. See, everyone wants that next AI winning name, but very few investors are paying attention to the infrastructure businesses that enterprises already depend on every single day. Salesforce sits at the center of customer relationships for businesses all over the world. Sales, marketing, customer services, even automation, and increasingly AI-powered workflows. Now, the market narrative is saying that AI could disrupt Salesforce. we think AI could make Salesforce even stronger. The numbers are impressive. The company generated roughly 14 billion in free cash flow, and at the same time, it has more than 70 billion in contracted future revenue already on the books. That's not projected revenue, that's not management guidance, that's revenue already committed by customers, and in today's environment, that kind of visibility really matters. And management is also aggressively buying back stock, recently announcing a new 50 billion share buyback authorization. That's a huge vote of confidence. At TLI, we've heavily researched this opportunity, and our discounted cash flow model suggests a price target sitting around $395 per share. What's interesting is that we don't even need AI hype to get there. We simply need the market to recognize the value of a business generating enormous amounts of cash flow with extremely predictable future revenue. Salesforce may not be the most exciting company in the market, but it just might be one of the most mispriced companies today. Before we get into the final stock, let me know down in the comments, which one of these businesses do you prefer? High growth company names like C Limited or cash generating giants like Salesforce? I'd love to hear your thoughts. Now let's talk about the final company today, and honestly, this might be the most interesting setup of all of them. The company is Grab, ticker GRAB. Most investors still think that Grab is a ride-hailing company, and that's a mistake. Grab is becoming an entire ecosystem, be it transportation, food delivery, payments, financial services, merchant services, all connected inside a single platform. And here's what's really interesting. The business today is fundamentally stronger than it was when the stock traded near previous highs of about $16, $17 per share. More users, higher spending, better profitability, and better margins. Yet the stock remains dramatically below these previous highs, trading at about $3 to $4 today. That's where the opportunity starts to appear. These are financial products serving millions of underbanked users across Southeast Asia. And Grab already has a huge advantage. It owns the customer relationship. People already use the platform. They already order food, they already take rides, they already use the payments. Financial products become the next logical step. A customer takes a ride, then orders food, then starts using Grab Pay, then eventually uses lending or insurance products. Each step increases customer value. Each step deepens the moat. Each step strengthens the flywheel. At TLI, our research suggests Grab could be worth around $7 per share. Our discounted cash flow model points closer to $8. Meanwhile, the stock trades far below previous highs at around $3.50 per share today. Now, from a technical perspective, sentiment remains weak. Many investors are frustrated, but those are often the environments that the best opportunities start to appear. You see, the market still sees Grab as a ride-hailing company. We see a financial ecosystem that is still in the early innings. And quickly, if you want our full chart analysis, price targets, portfolio updates, and watch lists on these three companies, I'll leave the Patreon link in the description below. We have a free trial option, give it a go. Now, let's wrap this up. So, where do we stand today? 3 businesses, 3 different markets, 3 powerful moats. And in our opinion, 3 opportunities in the market still doesn't fully appreciate. C Limited is building an ecosystem across e-commerce, gaming, and fintech in some of the fastest growing consumer markets on earth. Salesforce continues to generate enormous amounts of free cash flow, is aggressively buying back 50 billion worth of its own stock, and has 70 billion of future committed revenue locked in. This is all while investors are focusing on more speculative AI names. And Grab is quietly building what could become the financial infrastructure for Southeast Asia. If I had to summarize in one sentence, it would be this: the market is still valuing these companies based on what they used to be. We're looking at what these companies could become over the next 5 to 10 years. But obviously, every investment does carry some risk, so do your own research and join us on the Patreon to see ours. So, C still needs to continue improving profitability. Salesforce needs to prove AI can become a tailwind rather than a threat, and Grab still needs to execute on the monetization of GrabFin. But those are exactly the things that we're watching, not headlines, not short-term price movements, the actual business fundamentals. If I had to rank them today, Grab probably offers the most asymmetric upside. C Limited offers the strongest balance sheet growth and quality, and Salesforce may be the safest value opportunity of the three. These are businesses that we are potentially looking to own while they continue to compound for years to come. Because that's where real wealth gets built, not in a quarter, but across an entire cycle. Thanks for joining today. Drop your thoughts below. Which of these three stocks would you buy today? And subscribe if you're new. I'll see you in the next one.